Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
A whistleblower claims Fidelity has been pushing high-fee products to their clients instead of lower-cost alternatives. And not to be outdone, a trustee is claiming Schwab is hoarding the estate and not letting distributions happen. And if we go from custodians to advisors, is your advisor cherry-picking at your expense? And not to be outdone, we've always got the government. Are you ready for 2033 Social Security? If we don't fix something, 20% cuts across the board will go into effect. 20% plus cuts would have to go across the board. Anyway, let's get right to it. And then don't forget, next Friday morning, Don Vandenbord, our portfolio manager at Revere, and my partner, technically shareholder, is going to be on IBD Live. And that starts at 8:30, Don?
9:20 Eastern Time, 8:20 Central.
Got it. All right, so let's get right into it. A whistleblower claims that Fidelity has been pushing their advisors to put them into higher priced products. Now, this isn't just like a disgruntled employee that's been there a couple years. This guy's been there for 24 years. He's worked for 24 years at Fidelity. He said he was pressured to place clients into Tier 3 investments, the highest revenue generating products Fidelity offers, versus Tier 1 or even Tier 2. And this was actually happening at a branch in Dallas. Anyway, all of this article is in the show notes. I think there's probably some truth to that. I've seen the other side. I've seen the brokerage commission side, and that's how they work. Now, a trustee at Schwab, who actually was a trustee of his father's estate, is claiming that Schwab has breached their fiduciary duty and not allowing these assets to be distributed. Now, I will tell you, folks, the first thing about Fidelity, there's probably a lot of truth to that. The second one with hoarding the estate, that gets a little tricky because estate settlement can be tough if you don't do everything right and you get it all in order. Sometimes it takes a little while to undo that, especially if you got real estate or other assets. It may take a while. Anyway, the cherry picking article is also in there. But the point is, that is why you need a fiduciary advisor that avoids conflicts of interest. Okay? For instance, when we buy something, we buy it at the master level and then allocate it across the board so everybody, including Don, myself, and my own mother, and you, get the exact same price at the exact same time span. There is no cherry picking or front running at Revere ever. Also, a way that advisors can help, because there was another article that talks about beneficiaries. It says the ex-girlfriend in a 401k cautionary tale. Folks, you got to make sure your beneficiary designations are accurate and up to date. You got to know how to do them. Now, in the case of divorce, usually what happens is the ex-wife or ex-husband is automatically removed from your 401k. You would actually have to add them back in manually in case there was children's support or something automatically back on after the divorce to reestablish that, if that's a court order or what have you. But here's the biggest mistake people make with beneficiary designations. If I've got 3 kids and I want it to go to my 3 kids, a third, and they've got kids, and I've got a third, and one of the children, because they love me so much and they know that they're going to inherit money from me, so they want to show their gratitude, they take me out to dinner. And a drunk driver hits us and creams both of us, and we're gone. And that child that died with me also has kids. if we didn't have it designated on their share per stirpes, P-E-R-S, new word, S-T-I-R-P-E-S, that it's Latin meaning down the tree branch, but basically it means down the genealogy, then the other two surviving children would get all of my estate 50-50. The children of my deceased child would get left out. So it's very important. So in other words, you have to have all primary beneficiaries completely wiped out before it goes to any contingent beneficiaries. Okay, so everybody thinks they've got the grandkids named of that one child as contingents. None of the contingents see a dime until all the primaries are taken out. Unless you have it per stirpes, then it would follow down that contingent. If you got any help on that, just let me know. There's also new estate rules on new FDIC limits on trust, even revocable trust. So you want to make sure that you're getting the maximum limits. That gets a little complicated. You can call me. And the IRS released new HSA contribution limits. They upped it by a few $100s. And there's new limits on all the retirement plans, all that stuff. But that's all the planning. But that is why it is important that you get things done right and that you don't have conflicts of interest with your broker. I did get an interesting article, or actually comment, about last week's show from Uncle Tony. And then additionally, in last week's show, or a couple weeks ago, I was talking about journaling and why it's important when you're picking stocks and you're looking at items. If you're managing your own money, it's always important to keep a journal and journal right before you take the trade, buying it, while you're holding it, and then when you sell, because when you analyze it on the sell or you're looking at it backward looking, it's very easy to Monday morning quarterback. It's very easy to read things into it that you may not have perceived later. The old adage is it's easy to read the left side of the chart. It's very hard to read the right side of the chart. In any event, because it hasn't happened yet, right? Anyway, I was talking about that, and Uncle Tony said, he's an avid supporter and listener of the show. Uncle Tony sent me a text saying, you should really also mention that you should journal the overall market conditions as well, not just the stock. He's exactly right on that. Now, in lieu of the mailbag this week, and kind of setting up the whole format of this show, talking about Revere and what we do and how we do it, and tying into Don's IBD Live coming up next Friday, okay, I am going to read. So they ask him for a bio, and I'm going to read this very quickly, okay? It's not an exaggeration. I owe my career to the team at Investors Business Daily. Here's my story. I grew up in a working class family, paycheck to paycheck. Let's start over. I grew up in a working class family, lived paycheck to paycheck. Nothing about stocks or investments was ever discussed. I earned an academic scholarship, attending college and graduating in 1986 with an IT degree. I put some money in mutual funds and a 401k. After the 1987 crash, I panic sold and mostly stayed there, paying little attention to the markets. Fast forward, late 1999, I got married and having my first child. I finally started paying attention to the markets again and got caught up in the internet euphoria. Doubled my money to about 100K, round-tripped it because I had no sell discipline, meaning it basically lost half his money. Simultaneously, my father-in-law fighting a melanoma, a battle he would eventually lose in 2002. After he passed, we found out his nest egg with Morgan Stanley was decimated, over $1 million to $500,000. I realized that one of the supposed smartest firms on the planet, on Wall Street, was actually as dumb as I was, with zero sell discipline. It made it very personal for me. I set out to find a strategy to allow me to keep the gains during bull markets by identifying when market weakness was developing. I came across IBD, Investors Business Daily, and the CanSlim rules of William O'Neill. I was hooked. I now had a framework for a sound process. I was completely unfulfilled in my IT career and started thinking about a second career as an advisor offering downside protection to clients. I realized if I was going to be serious, I needed to commit. The only way to do this was to learn from the best over the next few years. So March of 2007, Don attended the Level 2 IBD Intermediate Strategies Workshop in Miami. February 2008, Level 3 IBD Chart School in Orlando. May of 2008, Level 4 IBD Masters Program, Santa Monica. December 2008, Enhanced Level 4 IBD Masters Program, Santa Monica. They like Santa Monica. That's where they're based. March 2009, Level 5 IBD Model Stock Summit, and 2011, IBD Market School in Chicago. Interestingly, I met George Kachuk at Market School and talking about our desire to manage money using CanSlim. Dreams can come true for both of them. 2008-9 financial crisis reinforced my desire for a career change. I dodged the carnage of 2008 due to my IBD sell rules, but I saw people getting crushed the same way my father-in-law did back in 2000 to 2002. In 2012, I was laid off in my IT career from downsizing, and it was time to pursue my goal. I created an investment process resume focused on trend following and the IBD stock selection process, working part-time at a Jacksonville firm. When my portfolio did well, I asked for a raise. He was a value investor and a founder of the firm, and he was founded on modern portfolio theory, which we're going to talk about. He told me I would never beat the market long term using my process, and there was no future growth prospects there. We parted ways, and in 2015, I was fortunate enough to find a firm out of Dallas named Noram Asset Management. That was me. And an active management and IBD approach with $20 million under management. I started with no salary, earning only fees from a few friends and family accounts. My process worked, and I lobbied my boss to allow me to partner with him and buy out Noram. We changed the name to Revere Asset Management. Same company. The parent company, Noram Capital, is still around. We didn't want any confusion there. So to buy out Noram. I cashed out my part of my 401k and co-founded Revere Asset Management in 2016. We now have 150 million assets under management. We dodged a 2018 Q4 bear, the 2020 COVID bear, and the 2022 inflation scare bear. Scare bear, I like that. Thanks to IBD inspired sell rules. Our approach is half systematic trend following on based on moving averages primarily, and half discretionary buying on leading stocks in bull markets. I produce a video every night at revereasset.com. Just go to Revere Asset and hit subscribe. Be delivered right into your inbox. And on YouTube. Our audience is constantly growing. It turns out that people like being able to sleep well at night, knowing their nest egg is safe, and they can outperform or even perform well against the pie chart never sell advisors. IBD is responsible for that. As for, and as he's talking about them to IBD, this was a note he sent to them. As for the education segment, I have developed a method to quantify risk of exposure of a portfolio using beta and ATR percentage, average true range, for each position. We'll talk about that in a minute. As you know, there can be a wide range of risk for a variety of portfolios that have the same percentage invested, meaning if you're 30% cash and you're 70% stocks, those three, you could have 5 portfolios and they could move very differently from each other depending on the underlying stocks they own. Okay. It's not an overly complex method, so people's eyes won't glaze over. I love that. And we're going to, hang on, Don, we're going to be getting to that in just a minute. So I want to talk about that a little bit. I'm going to talk about my own personal experience with my own father. He's passed away now, but we had the similar experience during the tech wreck. I had about half his money, and he had transferred the other half of his money in end of 2098 from a guy named Stephen Abernathy, a hedge fund guy up in New York that all he did was tech and biotech, very volatile, right? Transferred in, and he in 2000 I called him up at the beginning of the year and said, Dad, this is unsustainable. The markets are just going up too far, too fast. We need to take some profits. It's not sustainable. Oh, let me talk to my partners. Now, he's a doctor, so they study a lot of medicine, not economics, finance, time value, money, portfolio management, quantitative analysis, and things we need in this business, including technical analysis. And he came back and said, my partner said that the economy's doing well, interest rates are low. I don't want to pay the tax. I want to buy and hold. Okay. I was young in my career. And this was my lesson too. I learned that CFA and fundamentals are not enough. Anyway, he lost quite a bit of money within a month or two after March, called me up freaking out. And by the way, we used to call him, well, I can't say this on the show. We used to call him Iron Cojones Stewart because he was down in sub-level 2 in the radiology department you couldn't get a hold of him. And he said, don't call me during market hours. During my working hours, I'm trying to save people's lives. Don't bother me unless it's really, really important. So we wouldn't call him. And when the market went down, he didn't really notice, didn't care, wasn't paying attention. And if he saw a little dip, he'd add 50 grand. He'd add money. All of a sudden, he retired. Now he's sitting in front of Fox, CNBC all day long. And all of a sudden, Iron Cojones Stewart, we found out he was actually a little softer than we thought. He'd call me up and go, oh my God, my portfolio, it's down 25,000 today. Now, granted, he had a big portfolio. I said, Dad, your portfolio actually fluctuates 35, 40,000 a day. That's not that much. Big days, it could be even more. In any event, when he called me and said, oh my God, what do I do? I lost a ton of money. I looked at the slope of the line. It's still going down like this. I said, it is not too late to sell. We need to sell. Things are looking weak. No. He wanted, because then he wanted to know how you could get back in. Well, how am I going to get back in? Folks, you're only a couple trades from getting back in. Anyway, I said, okay. After one more month and lots more pain, he called me up and said, I should have listened to you. Do whatever you need to do. You were right. And it made him a very compliant client. From then on, I never had any problems with him. Now, here is what I want to talk about before we go to Don. Modern portfolio theory is that asset allocation theory that tells you that you can have a pie chart of stuff, set it and forget it. It's a pie chart for all seasons based on your risk and your risk tolerance. Guess what, folks? The market risk, the sector, the stock risk, and the market's time horizon trumps your market, your risk, or your time horizon. Now, I'm not saying your risk and your time horizon isn't important. I'm saying you've got to dovetail that with the markets because otherwise you'll get run over. But modern portfolio theory assumes that you can buy a pie chart. You've got these things. Some things are going up when other things are going down so that when we go into a bear market, you'll be offset. It won't be nearly as bad. Folks, you want enough diversification on the way up so that one position like an Enron doesn't cream you. They're cheating on the books and you didn't know about it. So one position doesn't absolutely kill your portfolio. But on the way down, all the correlations grow together and they all go down together, albeit at different rates. So when the market's going down, you don't want a diversified portfolio. You want cash and treasuries, or maybe gold and treasuries. And if those two are correlated highly, gold and treasuries, that means it's a fear trade and we're in trouble. In 2008, the only two sectors that went up were treasury bonds and gold. Even investment grade corporate bonds were down double digit in 2008. So in 2008, if you had a diversified portfolio of 60-40, 60 stocks, 40 bonds, you were still down 35%. Okay? Remember that. Now, modern portfolio theory also assumes that returns are under the normal standard distribution, aka the bell curve. Remember the bell curve from college? You got the mean right down the middle. Half the returns are positive, half the returns are negative. Returns are not under the bell curve. They don't display that shape. Okay? Therefore, all those numbers, it's fuzzy math. It's like a giant stepped on that bell curve and squashed it, so you had fatter tails or more tail risk than they're actually measuring using the standard deviation or variance. Not to dive too deep, I'll make it real easy and make an analogy for you. It's like they're measuring for the 100-year flood, but it's coming every 7-8 years. Why do I say every 7-8 years? 1929, 37, 45, 53, 60, the crash of 67, 73, 1980, the crash of 87, 1994, the tech wreck of 2000, the economic crisis of 2008. We started crashing in 2018, but like Don said, but the market, the Fed came in and short-circuited it with money printing. And then we had the COVID bear in 2020, and then we had another bear in 2022. So they may be even be getting closer together. Point being, folks, compounding works both ways. So on the way up, it's great, but on the way down, it's horrible. So if you can minimize, look, it's not that we don't go down during bear markets. We just go down a third or half as much. We don't go down nearly as much. So it makes it a smoother ride. We're just not blowing it out of the park and crushing the S&P. We're making market-like returns, but with a lot less risk and drawdown. So number one, it's easier to stay the course. You don't get scared out of your strategy, number one. Just think back. Think how you felt in 2008. Did you sell out? Did you say uncle? Could you sleep at night? Think about the COVID bear when it dropped 35% in literally 3 weeks. How did you feel then? What actions did you take? Okay, that's the first thing. Second thing is, even if you could ride it out, if all of a sudden you need the money, that's right at the time you need the money, it's not there. And you can't hold long enough to let it compound up and recover. That's why that sequence of returns reports that there's new studies showing sequence of returns that show when you actually retire, the biggest variable of how well your retirement is actually when you retire. If you go into a bear market right before your retirement, your retirement funds are cut in half. Why is that? Because all the compounding happens in the last few years right before retirement. 8% on $10,000 is $800. 8% on $100,000 is $8,000. 8% on $1 million is $80,000. If you don't get those last 3 or 4 years of compounding, that's hundreds of thousands of dollars that you don't get. That's why it's important. So the older and closer you are to retirement, the more important a sell discipline becomes. So the buy and hold guys will tell you that the market always comes back. And while that's true, it's fine if you've got the lifespan of an elephant or a tree, excuse me. If you got the lifespan of a tree and you got 200 years to bail you out. But humans, we save aggressively for about 30 years, and then we retire for about 30 years. So we got that window. And there have been 10-year time periods where the market didn't do anything. In fact, it was down. So if you hit one of those decades right before retirement, what are you going to do if you lose a lot of your money right before retirement and then you don't get a recovery for years? That's why it's important. And so with that, Don, I am going to ask you, where are we in time and space in the markets? And what are your thoughts on my comments? And how excited are you about IBD Live next Friday?
Yeah, Dan, that was a lot there. And I completely honored, excited, a little bit nervous about being on it. But from picking up a a book and a copy of a newspaper to managing with you $150 million based on a set of rules that a fine gentleman, William O'Neill, was kind enough to share with the world. It's something. It's I get humbled thinking about it.
It's a culmination of your career right there, man. It's awesome.
Starting, and then, like I mentioned, walking down the street with George Kachuk, and he does the same thing in Chicago right now for a firm. So, I mean, there we are sitting, learning, like I said, from the best. And these, they, of course, they have a product to sell, but it's a product that's worthwhile. And the results speak for themselves. So where are we in the market? Let's go back to last Friday. We were regaining the 21-day moving average and running into the 50-day moving average. And then Monday, we gapped above the 50-day moving average. So that gave us 3 days up. You always get wary when you have 3 straight days up that you need a pause. I'm going to go to a 15-minute chart here. On the 4th day up, we got that pause in the afternoon right here. Kind of a weak close, and then gap down the next day, but not a bad day at all. And all it was this is called a bull flag. You go up, you rest for a little bit, and then, as I said on the video, consolidation should resolve in the same direction of the primary trend. In this case, the trend up off the bottom from the FOMC. We broke out. And then we gapped up again this morning. Then, of course, the market always seeks to fool the masses. As soon as everybody piled in on that second gap up, at 10 o'clock, consumer confidence numbers came out, and they were not good at all. But reversed those gains right back to basically flat on the day where we closed yesterday. Still a normal pullback. We trimmed a few positions that were underperforming. We're always looking to pull the weeds to water the flowers. That gives us capital available to put into names that are working, leading stocks doing what they should do, outperforming the market by a factor of 2 to 3. In some cases, like Kava, what we have is outperforming 6 times since we bought it. Ted and Connor recommended that one for the portfolio, and it's doing fantastic. And when you get big 20, we're up 25% on that. That pays for all those little 3-4% paper cuts that you take when you get one that runs like that. And that's part of the trend following process. A lot of small losers, but when something works, you let it run until it gives you a reason to sell it. So the trend is your friend until the bend at the end is what trend followers say. And then that's pretty much what you've seen in this market. We started with the run up in November, and we just rode the wave. We don't know how long the wave is going to get. Then, we broke the 21-day, and then we broke the 50-day moving average. Then it's time to correct. We pull back, reassess, lighten up, see what the market's going to do. In this case, it held at the 20-week or the 100-day moving average. Tried one bounce. It was strong. Faded at a normal resistance area. This is the 50-day moving average. It turned from support to resistance, and then we broke through that resistance on the second try above, and that's where we are right now as of 12:15 Eastern time on Friday, pulling back a little bit from that negative consumer sentiment, but it's nothing at this point to be concerned about. Now we'll just, again, ride the wave up. This could end next week. It could end next month. It could end later this year. Traditionally, with the presidential cycle, you have strength in May, a little bit of weakness in the summer, and then more strength down around the October timeline. And we're familiar with seasonality. It's not a primary indicator; it's a secondary indicator. And every day we assess our stops for every position that we have. And if things start breaking the moving averages the way they did in April, we reassess, lighten up, and then we've got the same rules we've got rules just like we have rules to get us back out. We've got rules to get us back in, and it's a matter of following trend lines, moving averages, and resistance and support levels.
Well, that's always a big question I get. Well, if you sell, how do you get back in? I mean, people ask me that all the time, and they think, in their mind, especially for the pie chart, the people that have been kind of trained to think of that pie chart asset allocation and not make any changes, they feel like it takes weeks or months to get back in. No, it's 2 minutes. It's literally, you could get back in a few minutes.
It's 2 minutes to start it, and then if you get traction, you add. If you don't, your stops will get hit, and you'll take you right back out. We're not predicting anything. We're letting the market tell us what to do, by its strength or its weakness.
Right. We're measuring. So I always say this all the time. We measure what is happening while it's happening in real time and make adjustments accordingly. And we also say it's okay to be wrong. It's not okay to stay wrong. So if we take a position, a setup, and all of a sudden it turns because the market changed character or the stock changed character, then we're out. And by the way, that wasn't a mistake going into it. That was just a mistake with hindsight looking back. Okay, if that same setup happened again, we would take that same stock and set up again unless there was something better, more compelling to do. All right, Don, go ahead. I just wanted to add on to that.
Yeah, and so what and Ted's going to talk a little bit about this now. We mentioned this on the call earlier this week, and he just dug to the next level and came up with some good evidence. We're always looking to weigh the evidence. So when we broke back above that 50-day moving average earlier this week, we start looking for the market doesn't always exactly repeat, but it rhymes, and it was acting just the same way that it did back last August, where we had a nice run up. We rolled over, broke the 21, broke the 50, and then rallied back up through the 50-day. Very similar to what we have now. So this setup that I'm highlighting here looks basically exactly like the behavior of the market last August right here. So the question is then, are we going to continue higher, or is it going to unfold the way it did back in last August and September, where it was just temporary and then we rolled over again, and then we had a second leg down and then a third leg down before we finally put in the bottom in early November? So we're comparing it to that area in August, or is it going to be when we came up through the 50-day moving average back here in November, right when we were kicking off that big rally that we just pulled back from? So we're comparing both scenarios. They both look very similar to what's happening now. One of them has us continuing higher. The other one has us rolling over. And we use the moving averages and support resistance levels to tell us how much capital should stay in the market. And again, it's the market telling us. It's not us predicting.
But right now, those moving averages all are kind of together and looking like they're hooking upward. The shorter term,
it's acting exactly the way we want it to with this this little bull flag, that we had, that we broke out of yesterday. And as long as that flag doesn't fail, which is about 51.90 level, that breakout would fail. So we've got a target there. It's 25 points down from here.
What is that? A 10-day chart you were on, or what was that? Well,
that was a 15-minute.
Okay.
Yeah, that's a 15-minute chart that showed the bottom from the FOMC. Remember, we sold off so hard that day. Everybody thought the sky was falling. And then we gapped up the next day and sold it all off within the first hour. And everybody's like, oh, man, we're going lower. We are so screwed. But we held right at 50.10, rallied into the close, gapped up the next day, gapped up the next day, gapped up the next day, and then finally started pulling back to put in this little bull flag, really it's a day and a half consolidation, and then we broke out of it yesterday. And all we're doing is we have very little exposure down here, but we add some more. Now we're extended third day up. This is where you want to get it in that first 3 days. You don't want to pile in after 3 days up, because you're looking at some sort of a pullback, because you just get stretched too far to the upside. But then the market resolved the way it should, exactly the way you want it to, on this 15-minute chart with this nice little bull flag, and then broke out higher. We put more on yesterday and put a little bit, no, actually not much at all on today, but we've got the market strength allows you to see strength and weakness, and we stopped out on 2 lagging positions to have that capital available if we want to put it into something that's working.
And
Kava
it's
continues to work. Micron, CrowdStrike, NVIDIA, FCX. And then there's things that aren't working, like Spotify. We bought it. Not everything, we know half of our buys are not going to work. You only have to bat 500 as long as your average winner is better than your average loser. And in our case, it's about a 2-to-1 ratio on how much the average winner is versus the average loser. And, bat 500 and you're going to make money.
right. With less risk. The whole point is it's about risk management. So we manage risk first and let the returns take care of themselves.
Right.
If you get
Exactly.
if you get a little bit of a pop on the stock early, so you get a little bit of a gain, that helps you to be able to hold it because you always have a stop. Now, we don't use hard stops. We actually use alerts so that we get notified, because the market makers actually know where the stop losses are, and they rape the retail investors. They manipulate it so it kind of goes down right where all the stops are, and then they take them all. By the way, if you are using stops, if you are going to do it that way, there's better ways, but if you're going to do that, always use odd numbers. Don't put the stop just at $49 or even $48.95. I would put it at $48.93. I would use pennies within the nickel increments. I know that's counterintuitive, and I would put it just slightly under where you think because everybody's going to look at that even at $50 a share, $48.50. They're going to look at round, and that's where all the stops are once those are taken. So you may help yourself and not get stopped out as much. All right, Don, what else you got, guys?
My alerts are normally at least 1% below one of the critical areas like that, and it's because a lot of people say, "Oh, I'm buying this, and I've got to stop at yesterday's low." Well, if you put a stop just below yesterday's low, they're going to collect it because it's a natural undercut and rally spot. You have to give it you have to let all those stops get collected without yours being collected. So if 51.40 was yesterday's low, don't put your stop at 51.39. You need to go down to 50 and then a little bit below that, like 1%, a little bit more, or we normally calculate 1% to 2% below where we think everybody else's stops would be.
Right.
Just to stay in the trade. Nothing worse than getting shaken out.
Right. And then it going right back up.
Right.
All right, absolutely.
All right, so let's go to Connor first.
Yes. So today I thought it'd be a good time to kind of talk about, my weekend process of screening. Or Don, it's the other picture. You can show that at the end. But so part of my process in screening is looking at sectors and looking at groups. And so I kind of wanted to talk about what I like to do on the weekends to help me identify, what's showing strength in the market. So Don, maybe you could just walk them through this on Market Surge. But one super underrated tool that I absolutely love is the Market Smith 197 industry groups. So in that stock ideas tab, you can just click that and go to week review. And then you can go through all the different sectors and industry groups that Market Surge flags. And in these, on the right side panel, it will show you the the specific stocks in these groups. So this is usually the first thing that I like to do on the weekends to give you a gauge of what's strong and what's not. And like we've mentioned before, you don't necessarily want to buy the number 1 rated industry group. You want to get into an industry group that is making its way up to that, top 5, top 10 reading. And then another thing is looking at the Market Smith Growth 250. That's 300 of the best growth stocks in the market. And with these, you can see reoccurring themes, is there 6, 7 stocks in one industry group setting up? And when you go through that list, that's a great list of, some of the best stocks in the market. And that could hint to you, where's big money flowing into, or is it flowing out of? And then another tool I like to use is I use FinViz for this, and you've probably seen it on some of the weekend videos. Third thing I like to do is I like to look at the performance of, the spider sectors. So this can tell you like what led on the week, what led on the month, and then like the 3-month performance. And that can give you a good idea. And then, yeah, so this picture Don pulled up, this is how I've found what works for best for myself when organizing it. I always tweet this every weekend usually, but so I like to go through all the growth 250 and the industry groups, and then I separate them. So like you have retail, internet, there were 3 stocks that were setting up. So I put that in that category. And this gives me a good gauge of, is there a lot of stocks in the group performing? And in this tweet, you can see retail restaurants. I probably had the most names in that group because that group was really standing out to me and had more names than most groups. And I had copper in there, SCCO, FCX, tech. Those have been very strong, along with like the gold miners that broke out yesterday. So yeah, that's kind of my process. And I think one thing is everyone always wants the holy grail of screening, and it just doesn't exist. You can't make a scan that's going to just give you, give you the names to buy at the exact spot. You really have to flow with the market, and scans are a tool. The other side of it is the execution and the situational awareness. And to touch on the other thing, and I think a 6-month and a 3-month relative strength scan is good as well. This will tell you what's holding up, and mine is super simple. It really just consists of an RS rating of above 90, and then I just have a liquidity threshold on that. And that will obviously vary, between account size, what type of stocks you're trading. And I look for RS stocks above the 21 and the 50-day. And that's a super, super simple screen, but super effective. So yeah, it was pretty short segment today, but that's kind of my process on the weekends for narrowing down a list of actionable setups for the week ahead. And it's really very simple. And kind of the point I'm trying to convey is that scanning and screens don't have to be this super complex thing. You just want to know, what stocks are in play, what sectors are strong, and then you narrow down to stocks that are setting up with a low risk entry point.
So then you go from your list to actually taking action. And here's GDX that you guys recommended for Growtection as well. And you've got 2 AVWAPs on here.
Yep.
Talk about that.
Yeah, so the
Anchored
first
view up.
anchored view, yep. So the first anchored view up, that's from all-time highs. And as you can see, it spent years below it. And then recently there was change in character. It got back above, it came back and retested it twice. So that, that's giving me a bullish bias on GDX. And then this, the top blue line, that's from the 2020 swing high. And as you can see, it had, it had 3 false breakouts above. And this recent time, it broke back above, it kind of came down and retested it, and now it's falling through to the upside. And that, gave stacking the evidence for this trade that, that showed that GDX might have bottomed and upside looks more likely. And then just talking about groups, there was a ton of gold miner stocks that was outperforming. So that's what actually swayed us to GDX versus GLD. You had Newmont, that was a gold miner that gapped up on earnings. You had WPM, that was another one that was breaking out of a high tight flag. And then KGC was another smaller gold name, but that broke out of a high tight flag and has been running. So, and as you can see, gold miner GDX has been outperforming just the standard GLD. So that was a subtle difference in why we chose GDX over GLD.
Good stuff, Connor. Thanks so much.
Yep.
Ted.
Yep. Alrighty. Don, can you pull up up the chart of the NASDAQ composite on MarketSmith?
All right.
Yeah, so as Don kind of hinted at before, we were comparing this recent rally to the correction, this recent correction to the correction from August 2023 through November 2023. And I just want to dive deeper into that and kind of go a bar by bar analysis. So Don, can you change the market surge time frame back to September 1st, 2023? And as Dan mentioned earlier, we want to get rid of the right side of the chart so we don't have that hindsight bias. So immediately, and then can you go on the weekly so we can see the whole chart? Immediately, the difference between this time around versus where we're currently at, we had a lot more supply on the left. As you can see, we had 3 big waves down on the weekly. So we were coming into that 14,600 level. And after almost 6 out of 8 weeks up, it makes sense that you need to correct, because you have people who bottom fish the lows who are at a great profit. And then you also have trapped buyers previously that want to sell for break even, because that's usually the natural or the normal human tendency in the markets. And that is what kind of started the correction. When you really zoom in on the weekly charts, you had those 3 weeks down on above average volume, and then you rallied 2 weeks, and the second week was back above the 10-week and the 50-day simple moving average. But as you can see, when you take a look at the volume, the 3 weeks down were all above average, and the 2 weeks up were below average. And that just shows that there are a lot more sellers than buyers on average, and that took us down for another two legs. And then can you go to present day? Now, present day, it was an extraordinary rally. I believe it was about 18 out of 22 weeks up since the bottom of the November correction, and we made a new all-time high on the NASDAQ composite. So what that means is everyone who bought under that is at a profit now. And when we started correcting, you don't have nearly as much supply. You just have people at profits that perhaps will take some profits, and maybe a little bit of trap buyers who bought the absolute top, who are looking to get back even. And when you look at the weeks, you don't even have, like, in these last 4 weeks of selling, 3 of those had very low volatility, less than 1% down on the week, and then you had this big bar that was minus 5.5%, and it didn't even break the average volume on the weekly chart. And then the following week after that big break, you had a rally that was lower on volume, but then this next one that broke back above the 10-week was pretty much above average volume, just about above average volume, and in line with that big knockdown bar. And so the volume characteristics, the present volume patterns, these little subtleties did point out that perhaps there would be more room higher, and that it was different than the precedent that we're looking at. If you go on the S&P chart, the volume characteristics, the differences between the July correction and this most recent one, you could see it's more pronounced. That weekly candle that broke above the 10-week recently was clearly above average volume versus prior, where you had low volume rallies on the weekly. And so that's just the price and volume action of the S&P and the NASDAQ. And then some other subtleties, Don, if you could bring up the 2 charts. The first one was net highs and net lows, and then the NASI indicator for the NASDAQ. So on the left side, I have the green circles from the prior correction and this recent one, and with corresponding to the net highs and net lows at the bottom. As you can see, net lows plagued the markets in that August through November correction. Whereas this time around, when we poked our head above the 50-day and the 10-week, we actually saw some net highs. And even though that's just a small change in character versus the last correction. It was something I noticed and pointed out to the team. And so far, we are resolving higher. It seems like that price action is not as aligned to our precedent, but anything can still happen with CPI and PPI next week, as well as NVIDIA earnings. As Don talked about, as Dan talked about, we are judging it in real time and what we have currently in the present moment. And then on the right side, another subtlety. When we poked our heads above in August, the NASDAQ was already trend correcting, breaking below the 10-day moving average. While this time around, the NASDAQ already corrected a fair amount and was breaking and sloping back above the 10-day moving average, with the RSI crossing from oversold into the neutral territory, and the MACD also signaling a bullish cross. And then finally, Don, if you can bring up the fear and greed index from CNN, pretty much paints the exact same picture, except this is more of sentiment and not our secondary or primary price and volume indicators. In that August through November correction, we were in the extreme greed area, heading into neutral and into extreme fear. But this time around, we dipped almost into extreme fear. We were in the fear area, and now we're rallied back into the neutral area. And so what this tells me is that if we continue higher, there were a lot of people kind of worried about if this rally was like the precedent that we're talking about. And when we looked on social media and just saw what other traders were thinking, everyone was pretty much worried about this having 3 legs down, just like the last one. So those are some subtleties I noticed, which can give us a pointer to our decision-making in buying leading stocks as well as the indexes, which we have re-engaged well so far. And we can only just take it day by day and week by week as it comes.
Man, this is why I love working with these guys. Putting the work in, digging down, coming up with the details. Compare that to what a pie chart advisor does. They have 3 steps. Step 1, tell the client to fill out a risk tolerance questionnaire. Step 2, stick the client in a pie chart depending on their risk tolerance questionnaire. Step 3, hope. That's it. That's the 3 steps. And if the client calls and complains, tell them, well, it's going down. Everybody's losing money. We want to think long term. And did you get the desk calendar that I sent you on Christmas? And as Dan said in that letter that I wrote, this is personal for me. I saw my father-in-law and his widow get decimated. I saw friends and family in 2008. It happened again 5 years later. Did they learn anything the first time? The pie chart people? No. This is why we do what we do at Revere. We're not in it for ourselves. We're in it to make people's lives better. Let them sleep at night knowing that what they saved isn't going to go away with the market. You don't have to be at the mercy of the market in downtrends. Great job, guys.
Absolutely. So here's another thing to add on to that. I want to mention, is your advisor actually screening, like Connor said, his weekend process screening for charts? Is your advisor actually working some on the weekend screening and looking for charts, or is he out playing golf? I don't know. I'm just, and in the pie chart business, Don, I say this all the time, it's not the investment business, it's the changing of the investment business. Because when your stuff transfers in, they liquidate everything you have and buy what they are pushing, because they don't get paid unless you own what they have to push. In fact, one of the discount brokerage firms that will go unnamed that actually have intelligent portfolios, right? They don't charge on cash. Because I had a client that came over from them and said, well, are you going to charge me on the cash portion when you move to cash? And I said, absolutely, because if we move to cash and it saves you from 10% decline, we go down some, but we don't go down 20 or 25 or 30. That saved you a ton of money. What is the difference? If you look at the difference, if you lose 10% more buying and holding on, hundreds of thousands, what is that dollar amount? She goes, and I said, but that's the other reason these other portfolios, these pie charts, they don't have you cash. They believe cash it because they don't get paid on it. They don't get paid on it. So if they don't get paid on it, guess what? They don't like it. Okay? I don't care what you own. If we're in real estate, we're in growth stocks, we're in gold, we're in cash, whatever it is. I don't mind taking risk. I just want to be overcompensated for taking that risk, and I want the probabilities in my favor. If it's a 50-50 coin toss, I can go play blackjack at Vegas for that. Okay? I'm not a gambler. I don't like doing that. Okay? I want to have some kind of systematic way. They say that it's just you just set it and forget it, and everything will be all right. So you got one pie chart based on your age and your station in life, and everybody that looks like you gets either a number 8 pie chart if they're kind of wimpy and real conservative, a number 12 pie chart if they're moderate, and a number 16 pie chart if they like to go to Vegas. They want a go fund. Well, guess what? Even if you tell me you're a number 16 and you're very, very aggressive, if that stock is dropping, I'm going to sell it because it's about that stock risk, not about your risk. I'm not going to hold something that's just crashing just because you tell me you're aggressive. So we manage to the market, and then we dovetail your needs along with that. In any way, I love that. The trend is your friend until the bend at the end. So the big question is, what are you going to do when the bend occurs? How ready are you? And does your advisor have a sell discipline and then a buy discipline to get back in? What are his rules or her rules? Those are good questions you should ask. Anyway, we've said enough. That was the show today, folks. Hope you loved it. Please tell a friend, tell a neighbor. If you just send them to revereasset.com in the upper right-hand corner, there's a subscribe button. You can just hit subscribe. This podcast will go into your inbox on Saturday morning once we do it. We produce this Friday morning, but if you subscribe to YouTube, just go to Revere Asset and subscribe to our YouTube channel. This will be your inbox by probably 1 or 2 before the market close for all the stock nerds. Also, Don's daily market insight videos goes into your inbox that evening. Every business day, the market is open. We put out a video every day the market is open. We're the most transparent advisor that I'm aware of. Folks, be safe. You can email any of us, Dan@revereasset.com, Don@revereasset.com, Ted or Connor at revereasset.com, and you can always call us old school at 855-REAL-WEALTH. Don't forget Don's IBD Live next Friday morning if you got a subscription. We'll talk to you next week on your money, not their money, your money.
Because it's not about how much you made in the markets. It's about how much you can keep.